In August of 2018, with the S&P 500 hovering near all-time highs. In this week's video, we'll review long-term charts to help us answer the question, are the setups in the stock market today more like the 1987 crash or the 1982 bash? In the financial markets, we can make decisions based on wild swings in our emotions. We can make decisions that attempt to protect our ego or to make us feel better about past decisions, or make decisions that align with prior forecasts that we've made. Often A and B lead to common missteps and disappointing performance. If we want to try to reduce the frequency of those common missteps and improve performance, making decisions based on facts and logic can help. Clients and regular viewers know that our basic game plan is to always ask, are we allocated properly based on the facts in hand? Thus, in these weekly videos, when we review and revisit similar concepts over and over and over, at some point in the future, we're going to uncover something that looks concerning. As always, we'll be doing basic pattern recognition. This looks complex and noisy. It's relatively easy. This is the S&P 500 quarterly. This is 1930 on the left side of your screen, and we're going to make our way all the way out to the present day in 2018. ADX helps us with the strength and direction of a trend. And in this case, using a quarterly chart, it helps us with the long-term trend. We're looking at a long-term period of consolidation. Price stayed inside of this box for 17 years. And according to Trading for a Living, the best signals with ADX come after black falls below both red and green. Black is below both red and green. When black rallies from below both red and green, it shows the market is waking up from a lull. Price tells us, from a long-term perspective, this is a sleepy, trendless market. ADX tells us this is a sleepy, trendless market. What happened next after ADX started to rise from low levels, black ADX, and price was able to break out of the orange consolidation box? The answer is good things happen for a long period of time. Harder markets are followed by easier markets. After breaking out from the top of the box, the additional gain from the top of the box to point B here was 506%, and the secular move lasted 22 years. Notice when the trend started, black ADX was at low levels. Here, black ADX, instead of being below both red and green, is above both red and green. This is an extended market. It's not a sell signal. It just tells us to pay closer attention. It's basically telling us that the market is further away from a base. You can see here when ADX started to fall precipitously here, that told us that the trend was weakening. And after that, the market, for the most part, went nowhere between this point here and this point here. Black ADX at this point here is at elevated levels, was sitting right around 56, and then it started to fall, which is quite a bit different than ADX down here, which was sitting right around 13 when it rose from low levels. This really doesn't look anything like this. Easier markets are followed by harder markets. In this case, the market went sideways for approximately 19 years. This box here is very, very similar to this period of consolidation here. Thus, when price breaks out of the box here and then retests it, we actually go back in the box and then move out. Does ADX look more like this concerning extended look here, or more like this waking up from a lull or a sleepy, trendless market look here? The answer is simple. This look here unequivocally looks more like this period here. It really doesn't look anything like this extended look here. And similar to this point here, we also have black ADX down in this range here below both red and green. Again, quite a bit different than black ADX being above both red and green. Harder markets are often followed by easier markets. In this case, from the top of the box here, the market tacked on an additional 1,168% and rallied for an additional 17 years. Within the context of a secular trend, it's difficult to even see the 1987 crash here. This is 1987 where my cursor is. Like this period here, where black ADX was above green and red, heading into the 1987 crash, we have that more vulnerable extended trend look. And then similar to this period here, when ADX fell precipitously, we basically went sideways. And in this case, when ADX fell precipitously, we also went sideways, but just for a shorter period of time. When black ADX started to rise here, it told us the trend was picking back up, and after that, the secular trend continued. And if we look backwards now, you can see at this point here, 1987, and this point here, which preceded this long-term consolidation period, a 19-year consolidation period, the look of ADX here, which is the year 2000, 1987, and prior to this consolidation, it really doesn't look anything like these favorable looks down here and the look down here. So going forward now, we have some reasonable tools to compare and contrast the present day. If the present day looks like this, it would be more concerning. If it looked like this, it would be more concerning. And if it looked like this even, it would be more concerning. ADX, especially when we use it on a quarterly chart, is not a timing tool, it's a context tool. What type of market are we in? A trendless market? A trending market? Is the trend healthy? Is the trend extended? Is the trend extended? And in this case, is the trend extremely extended, starting in 1998 and heading into the year 2000? Black ADX in the concerning periods 56, 52 in 1987, 61 in the year 2000, which is significantly different from black ADX at 11 and black ADX at 13 before good things happened. And if we add some red vertical lines, we can see how ADX aligns with price, starts to fall. To the right of that, we consolidate. Starts to fall, we're already in a consolidation period. Starts to fall here in 1998, telling us we should be open to a potential reversal. Again, not a timing signal. We would be using shorter time frames to make asset allocation and trading decisions. 1998, this is a little bit of a warning flare. This drop here is similar to this drop here, which is similar to this drop here. And after the warning flare and the beginning of the drop, the market was confused for a long period of time. So at this point, we're in late 2012 on our chart, working our way to 2018. And of course, the million-dollar question would be, once we got the breakout and where we are today, because we've rallied for quite some time from the top of this box, does the present day have this concerning and extended look? Concerning and extended look? Or does the present day have more of a constructive and we should be open to more upside look? Trading the chart in front of us allows us to make prudent and rational decisions using facts and logic. And in turn, that can help us control our emotions and keep our ego in check. Now that we have some excellent historical reference points, let's take a look at the present day. Now we're looking at the exact same chart as of August 22nd, 2018. And it should be noted, in the current quarter, the S&P 500 is up 5.28%, meaning the charts that we've reviewed in these videos in 2018 have helped us keep our emotions in check and helped us stay with the long-term trend. If we're looking at this chart with a flexible, unbiased, and open mind, it is nearly impossible to see risk in the look of this chart here. In fact, all three of the constructive periods have somewhat of the psychological characteristics of an inverse head and shoulders pattern. This is somewhat of a confused shakeout look. The market starts to trend here, and then it falters, starts to trend and it falters, starts to trend and it falters. Similar situation here. The key is at some point, both price and black ADX break out of the consolidation boxes. And in this case, good things happen for a long period of time. In this case, good things happen for a long period of time. And thus, the facts that we have in hand today, no opinions, no egos, no emotion, the facts tell us that we should remain open to the possibility that really good things could still happen for a long period of time. This percentage and this duration, and this percentage and this duration are both calculated from the top of the box here at point A, top of the box at point A. Given that we broke out of this box in 2013, and we've already experienced gains, if this secular move here and this secular move here is similar going forward, we could still rally from August 22nd, 2018 for an additional 12 to 17 years, and the S&P 500 could still conceivably, based on history and the facts that we have in hand, tack on an additional 232% to 595%. And that's simply based on extrapolating this move and this move from the top of this box, and then factoring in that we're basically 5 years removed from the breakout. And from a probability perspective, this point A here looks similar to this point A here, which looks similar to this point A here. And in these two cases, good things happen for a long period of time. Now, looking at this in isolation, it's pretty obvious that the present day looks similar to this period here and this period here. How does the present day compare to the unfavorable periods? It's also a factual statement. No opinions involved, no ego, no emotion. A factual statement that the present day doesn't look anything like the peaking process between 1998 and into the year 2000. This is an extended trend. All this is telling you is we are extended, way extended from this base here. ADX at this low here reached 15. In the present day, August 22nd, 2018, it's still only at 33. 33 doesn't look anything like 61. 33 doesn't look anything like 52. And 33 doesn't look anything like 56. If we move over here, ADX is still in the 30s in the early to mid 1980s, and ADX is still in the 30s here in the mid 1950s. That was a great time to invest. Mid 80s, great time to invest. And as always, it's extremely important to note we are not forecasting here in any shape, form, or fashion. We're simply making probabilistic statements based on the facts that we have in front of us today. If the facts change, A, we have to acknowledge that, and B, we have to reassess the probabilities. The key here is we don't anticipate that. We trade the chart that's in front of us. This is the chart that's in front of us as of August 22nd, 2018. If you're new to these videos, it's possible that you could be sitting there saying to yourself, but wait a minute, the S&P 500 bottomed in 2009 and has been rallying for over 8 years. There is no way stocks could rally for an additional 12 to 17 years. If you're thinking that, I can assure you in the present day you are not alone, and at face value, this seems logical. But what does history have to say about this concern? Remember, the 506% and the 22 years is calculated from the top of the box to point B here. Prior to that, the market had rallied for 8.43 years off a low. So right here, I have no idea what's going to happen next. Right here, I easily could have said, but wait a minute, the S&P 500's been rallying for over 8 years. There's no way stocks could rally for an additional 12 to 17 years. And yet, in this case, it was even better than that. The market rallied for an additional 22 years, and that's on top of the 8-year move off the low. The exact same logic that we just applied here applies here. This is an 8-year move off the low. Right here, we could have said the S&P 500 bottomed roughly 8 years ago. There is no way stocks could rally for an additional 12 to 17 years. And yet, from a factual perspective, while it may have been very, very difficult to believe looking backwards from this point here, the S&P 500 rallied an additional 17 years on top of the 8-year move and tacked on an additional 1,168%, and that's on top of the move from this point here to point A here. Thus, we have just proven with facts it is possible that stocks from the present day could rally for an additional 12 to 17 years. And while it would have been very, very difficult to comprehend a move like this, looking back from this point here, and while it would have been very, very difficult to comprehend a move of this magnitude and duration, looking backwards from this point here, it's very understandable that it's difficult to comprehend that we could still see an additional gain on this order of magnitude with this type of duration from this point here on August 22nd, 2018. Again, if you're new to these videos, you might be saying, what about valuations? What about 2008? You really didn't cover that this week. What about the widespread skepticism about the economy, the markets, and the future in general? And what about your small sample size? We covered all of those what about questions in last week's video, and you can find it by Googling this title here. And if we're going to trade the chart that's in front of us, it's incredibly important that we head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.